For more than 30 years, the global economy has basically run on one single incredibly powerful engine: China. It fueled our factories, it bought our raw materials, and it powered consumer markets all over the world. But now, after years of what seemed like unstoppable growth, that engine is starting to sputter. So, what happens when the workshop of the world starts to slow down? What are the financial shockwaves? And who ends up paying the price? Let's break it down.
Well, the short answer is pretty much everyone. We're talking about investors in New York, miners in Australia, tech companies in Silicon Valley. But how exactly does a property crisis in Shanghai send tremors through the stock market in New York? What are the hidden tripwires in this whole interconnected system? We're going to follow the money and map out the real risks.
Okay, so first, we need to understand the most immediate danger, and that is contagion. You see, China's economy isn't some isolated island. It's the central hub in the incredibly complex machine of global finance and trade.
To really see how this contagion spreads, you got to look at four main channels that connect China to the rest of us. First up, raw materials. China's insane construction boom made it the world's biggest buyer of things like iron ore and copper. As that slows, prices can plummet, hitting the profits of mining giants from Brazil to Australia. Second, global supply chains. Think about a company like Apple. It's totally dependent on China. Any disruptions there don't just delay new iPhones, they can actually trigger inflation for you and me. Third, China's a huge consumer market. When Chinese families stop buying German cars or American smartphones, it shows up, big time, on the quarterly earnings reports of Volkswagen and Apple. And finally, and this one's a biggie, investor confidence. In our connected world, fear is maybe the most contagious thing of all. A big sell-off in Shanghai can trigger panic on markets across the globe in just a matter of hours.
So to really understand the global risk, we have to look inside. We have to diagnose the problem at its source. So let's peel back the layers and look at the internal cracks that are now showing up in China's economy.
For decades, the most obvious sign of China's economic miracle was that forest of cranes you'd see across its skylines. Entire cities just seemed to pop up overnight. And this wasn't just about building homes. The property sector became the #1 investment for Chinese households and a massive engine for the entire economy. But this engine ran on a very specific and very risky fuel: debt. To wrap your head around the scale of that borrowing, just look at this number: $300 billion. That was the estimated debt of just one major property developer, Evergrande. The entire sector was basically fueled by these astronomical levels of debt, creating a bubble of truly epic proportions.
So, here's the crucial point. When developers like Evergrande couldn't pay their bills anymore, the whole machine just ground to a halt. Construction projects stalled, people who had put their life savings into apartments were left with nothing, and confidence in the entire financial system just evaporated. This wasn't just a housing problem, it was a threat to the entire economy. And this brings us to this core concept of systemic debt. It's not just about one company borrowing too much, it's more like a tangled web, where local governments borrow money to sell land to developers, who then borrow money to build apartments, which are then bought by families, who also have to borrow money. You see the problem? When one part of this web breaks, the stress can pull the whole system down with it.
That tangled web of systemic debt we just talked about? Well, it was fueled by an absolute explosion in borrowing. For years, China's relentless growth was financed by just taking on more and more debt. And look, during the boom years, that's fine. But as growth slows down, paying back that mountain of debt becomes exponentially harder. And that creates a really dangerous feedback loop. And on top of that massive debt issue, there's another kind of slow-motion crisis that's been building for years. See, China's economic miracle was powered by what they call a demographic dividend, a massive young workforce. But as you can see from this timeline, that advantage is now over. The workforce has peaked and the population is actually shrinking. For global brands from Apple to Nike, this means that once guaranteed market of young Chinese consumers, well, it's shrinking too. And that's a direct hit to their future growth plans, and of course, to investor expectations.
So as if all those internal problems weren't enough, China's also facing some powerful headwinds from the outside.
The whole global environment has changed, and changed dramatically.
You know that era of frictionless global trade that basically propelled China's rise? It's over. The trade war with the United States brought in tariffs, and more importantly, restrictions on access to advanced technology. And this has forced companies and governments all over the world to seriously rethink their dependence on China.
And all of this has led to a major strategic shift. For decades, the simple answer for any big company was make it in China. Now, for reasons of both risk and cost, companies are actively chasing a China plus one strategy. They're diversifying their manufacturing to countries like Vietnam, India, and Mexico. But here's the thing. This shift isn't free. For these multinational corporations, it means billions in new investment and massive logistical headaches, costs that could eventually be passed on to all of us through inflation.
So, facing all these internal and external pressures, what does the future actually hold? Is this the end of the miracle, or is it just the start of something new?
Now, the Chinese government has a very powerful set of tools to manage its economy, way more direct than in most Western countries. They can cut interest rates, launch huge new infrastructure projects, and literally order banks to lend money to struggling sectors. The challenge, though, is that every single one of these tools relies on creating even more debt. It's a strategy of papering over today's problems by borrowing from tomorrow's growth, and that is a gamble that gets riskier every single time they play it.
This is a really crucial perspective to keep in mind. The era of 10% annual growth is probably over for good. But that doesn't automatically mean disaster is coming. A lot of economists believe China is simply entering a new and, more difficult phase, transitioning from an economy based on construction and cheap manufacturing to one based on high tech and people spending money at home.
So this is the new reality. The next decade for China is going to be defined by managing these immense challenges, that huge pile of debt, the demographic drag, and a much more hostile global environment. But at the exact same time, we're seeing China become a world leader in new industries like electric vehicles and renewable energy. So it's a story of both immense risk and incredible innovation, all happening at once.
And that really leaves us with the ultimate question. For 30 years, the entire world got used to a China that grew at this blistering, unbelievable pace. That world is gone. The new China will be slower, it will be more indebted, but it will also be more technologically advanced. For global investors, for governments, and for workers everywhere, the biggest challenge of the next decade is going to be adapting to this new and far more uncertain reality.